Hi, folks. Thanks for joining us today for another stellar session of CPS Live. We hope you enjoyed the lineup today. If you have any questions for our panelists during the presentation, you can enter them into the chat or the Q&A panels, and we'll read those off for you. Or if you're feeling really brave, use your hand tool, and I will unmute your line, and you can ask it live. Without further ado, here's Mr. Tom Berkler.
Lisa, thank you. And I hesitate to take too long to kick things off here because I know when you tune in and see the quality of the folks that we have here, Matt and Steve and Rob, the anticipation builds very quickly.
It does.
Of course, the question Lisa Navarro asked me to say she especially got a new hairdo today for this show. So you might want to text in the little box and comment on that as well.
Appreciated.
It is March the 6th here, at least where I am, and being in a more Eastern time zone, I can tell you that the remainder of the day is coming in your direction. I'm actually in Kentucky today. You're used to me being in Athens, Georgia, but I'm in Kentucky, and I think that carries with it at least the suggestion that CPS is willing to go anywhere in the country that you need us to be to serve you adequately. And so we're here in the Bluegrass State, and what better way to kick off how CPS can serve you than with our disability person on board today, Steve Jones. Steve, welcome aboard.
Good to be here, and thank you everyone for joining us today and kind of keeping in theme with today's episode. I'm going to talk about commissions for disability insurance, or as we like to call it, income protection coverage. Now, first of all, commissions for disability insurance, pound for pound, stack up to any product in the market. The average first-year commission for disability insurance with our domestic carriers is 50%, and the renewals come in at 5%. Now, our average DI case here at CPS is around $3,000 of annual premium. So you write a DI case, first-year commission is going to be $1,500. And there's also renewals for disability insurance, and they usually pay out at around 5%. So you write a couple of disability insurance cases a year, and it really does add to your agency's revenue. And with that renewal stream, kind of think about that as mailbox money that's going to come to you for your in-force policy. Now, it's been my experience with disability insurance. Once a policy is placed, that the policyholders keep their plan, keep their coverage throughout their working years. And also another good thing about disability insurance, you don't have to worry about those annual renewals, those annual rate increases. There's not a lot of service work that's required once a policy is put into place. One feature and rider that we add into our disability plans is a benefit increase option, which allows the policyholder at certain intervals to increase their coverage as their income increases and not have to go through medical underwriting again. And with these policy increases, that increased benefit is going to be paid once again at first year premium. So a first year commission level. So, if you're looking for a way to get new clients, if you're looking for new ways to increase your agency revenue, make sure you're having those conversations with your clients about protecting their income. If something were to happen to them, a sickness or an injury, and they're not able to work. We do have a lot of marketing material that we can customize for you that you can share, with your clients. And, last but not least, remember that we're always here to provide support. If you don't feel comfortable maybe having that conversation with your client about protecting their income, or you just don't have the time, simply make the introduction to Tom and myself. We'll take it from there. We'll contact your client. We'll prepare the proposals. We'll take the application all the way through underwriting into policy issue, and you still get paid commission on the case on a commission split, type basis.
Yeah, and just to clarify, Steve, when you say Tom, you mean Tom Nichols.
Tom Nichols, my partner in crime, exactly.
If it weren't for you, Steve, I wouldn't know a darn thing about income replacement. So, Steve, a couple things occurred to me as you were talking about your topic today, and that's the commission structure. We're always trying to broaden the use or the sale of income replacement into areas of agents that are used to renewals. For example, P&C agents, health insurance agents. And it's probably a positive in the sense that you and I are surprised when we go in and they don't like these upfront heaped commissions. They don't feel as secure with that. And to come in and offer what on the one hand is a hefty upfront commission,
Yep.
and then renewals over a period of years, a lot of times appeals to these, let's use health and PC people in a way that doesn't normally happen.
It certainly does. And in talking to PNC agents on a regular basis, they're always getting hit up with renewals, having to fight just to keep their current block of business. Whereas with disability insurance, you buy the policy, you usually keep it until retirement. You do have those renewals that are available, policy increases, et cetera. So it can really, you write a handful of cases a year. It starts to add to the bottom line, which is definitely a good thing. And there's not as much service work involved after policies put in place. It's always a good idea to follow up on a regular basis to make sure they're adequately insured and they're exercising those increase options, but not as a lot of service work involved.
Yeah, well, your response there made me think of what's often maybe viewed as a negative with regard to the commission structure you just defined. And they said, that's great, but I lose a lot of my commission if it lapses in the second or third or fourth year. So you made the comment earlier that that's not the tendency with
Yep.
these income replacement policies. Yeah, some policies lapse, things happen, but on
Sure.
the other hand, it's your experience, these things run the gambit. People keep these in force.
Exactly, because in the earlier you write the case, as far as the younger people, they lock in those rates, and as you get older, just like in life insurance and other coverages, the premium's going to increase. So lock in those rates early. They pay the premium. Commission stream's going to come to the broker.
Yeah, yeah, good to know. Good to know. And of course, we always know there's a certain kind of unseen element there when agents keep getting paid renewal commissions. There's a tendency that the policy's better serviced from their end. And
Yep.
unfortunately, a lot of times, Rob, you and I see these heaped commissions on life policies. Yet the agent gets paid, and he or she is, unfortunately out of the picture sometimes. So there's less of a likelihood of that. So. But hey, it's the market, we deal with it. Steve, any comment closing before I move on here?
Now, Tom Nichols and I, we're always here. Kind of think of us as your back office when you do get those opportunities with your clients in regards to disability insurance, overhead expense, key person, and disability buyout plans. But
Yeah.
appreciate your time. Look forward to working with you guys.
Matt Anderson, one of the things you've kind of clarified my thinking on is I've always thought of, well, long-term care, that comes in handy because when anybody has an event, they go into the nursing home for their life. And you've been one to bring home to me the fact that the average LTC claim is really 3 years or less. But sometimes that fosters really the adoption of an adequate plan, and that people say, well, then I'll just buy a plan with 3-year benefits. And of course, then they aren't covered when things go a little longer than that. So you've indicated to me you're going to talk today about appropriate plan design, looking beyond the horizon of what is a typical long-term care plan and how people might economically extend the benefit period that they have out there.
Yeah, thanks, Tom. I think that's probably one of the most difficult things when it comes to long-term care planning is knowing what's the best way to appropriately design the plan. And benefit period is one of those components. If you look at the averages, the average length of a claim is 3 years. Tom, you mentioned nursing home, although that's the least frequent environment that people receive care, right? The vast majority of people are receiving care in a at-home environment or in assisted living. The average length of stay at a nursing home, Tom, is 6 months.
Wow.
And usually after 6 months, you're checking out permanently. The average overall length of care is right around 3 years. But that number is actually very misleading as well. And kind of an inside industry joke is, the most commonly purchased plan is a 3-year plan. But that's really the client has purchased way too much coverage or not nearly enough coverage. Because if you look at the data, most of the claims are less than 12 months, or if they're not over in 12 months, they're lasting significantly longer than 3 years. So when you're trying to do appropriate planning, that 3-year average, while it is the average, is actually the worst mark to tie your plan to because it's just too much or not going to be nearly enough. When I'm looking at insurance, you're typically in trying to insure something that's not as frequent, but has a high cost. And that leads me a little bit more towards the catastrophic type of claims. And generally speaking, those are the financially meaningful ones, right? If you have a 6-month stay in a nursing facility, you're probably fine without having coverage at all, right? You're going to have 6 months. It's not going to be fun, but you can pay $12,000 a month for 6 months and then be done with it. It's those longer claims that are happening at home and in assisted living that are lasting 5+ years that have a cumulative effect on your financial situation. And those are the ones that we're interested in making sure that we're protecting against, and generally recommend something a little bit longer than like that 3-year average that people automatically gravitate toward.
Yeah, yeah. And there's so many advantages to owning a long-term care policy. We've got to focus on one thing in our short time, but you mentioned one earlier that can't be overemphasized, and that is when you're paying the bill with long-term care, you get to choose who you use. And you mentioned the at-home care, and probably aside from getting the care in general, people's biggest desires, I want to be taken care of in my own home. And that's an advantage of coverage.
And that's really the advantage of owning a plan, right? Owning a plan allows you to get care at home, and not kind of go into that facility type of environment. So that's where we see the most people with a plan, they're choosing to stay at home, if not
Yeah.
assisted living.
Yeah. Okay. And Matt, of course, as always, you're available to help anybody walk through any aspect of the case. And
Absolutely.
thanks for getting on today. Rob, you and Lisa and I were talking about before we got kicked off here, just how many idioms or catchphrases in our language that have become part of the dialogue in America were really started by you. And not many people know that. But I used with Matt, choose who you use. You started that one too, didn't you?
I believe so. Yeah, that was me.
Rob, you and I go back far enough in the business, despite our youthful appearance, that permanent insurance was generally viewed as here to meet a permanent need. And of course, the one you and I run into most often is folks that are high net worth enough that they have estate taxes, and those estate taxes are always going to be there. But you're going to take us a little bit in today, and when it ever got to the discussion of living benefits for a permanent policy, usually we're talking, oh, the cash is available if you need it.
Yeah.
But you're going to expand a little bit today, as you've done many times in the past, with regard to the increasing array of living benefits, which are all rationale for buying a permanent policy versus a term product. Help us out here.
Yeah.
Talk about it.
Absolutely. So yeah, that's a trend we're definitely seeing in the life space, which is more and more carriers are coming out with new generation or next generation permanent products that have living benefits. And those come in a variety of forms. Long-term care is one of the most popular living benefits out there. Critical illness, people that are diagnosed with cancer can get access to cash to get additional opinions, better treatment, pay for the things they need upon diagnosis of something like cancer. So carriers have become more and more creative, more competitive, and as a result, we are starting to see more and more agents position the value of a permanent policy. Rather than, I go back 15 years ago, a young couple, a young individual might be just looking at the cheapest term insurance on the market. But what you can do is what I refer to as a combo sale. If you're looking for $1 million of protection, maybe $750,000 of that is term insurance, affordable, cheap, get the coverage you need, and then put 25% of it or $250,000 into a permanent policy. And for an example, a person age 45, male client, good health, non-tobacco, could get $250,000 of permanent protection with long-term care, cash value, and a critical illness benefit for about the cost of the family cell phone bill or their cable bill, about $250 a month. So a tremendous amount of value for a very, relatively affordable outlay.
And if we talk about the fact that there's now $250,000 available for a long-term care event, I think Matt Anderson can weigh in that generally covers what we talk about as a typical long-term care, incident. it's a lot of dough. And
Yeah.
but the hybrid plan you suggest doesn't require they pay the high permanent premiums for their whole life insurance coverage.
Exactly. You can get a portion of it in term, a portion of it in permanent, and get all the value that comes with permanent for about $250 a month, again, for a 45-year-old. Just to get a little bit more specific on the benefits. So the death benefit is $250. If you need to use that death benefit for long-term care because you can't take care of yourself, $5,000 a month for 50 months. Or if you're diagnosed with something like cancer, you could get $62,000 in cash to help, again,
Yeah.
additional treatments,
5,000 a month. To go to an earlier remark you made, Steve Jones is such a sports enthusiast, 5,000 a month is his cable bill, isn't it?
Oh, yeah.
I have a son-in-law who's going into the insurance business, and a discussion he and I had last night, Rob, talks to the expansion of these living benefits, because we were kicking around this accelerated death benefit, which is what you're talking about in the event.
Right.
Back in the old days, that was only in the event that you could show you were going to die in 6 months or something.
Right.
And these living benefits have creeped increasingly in a direction that it covered more and more situations.
Exactly. And those benefits are still out there, the terminal illness benefit. I was just highlighting the addition of the long-term care and the critical
sure.
benefit. Yep.
Yeah. But it wasn't a big motivator to say, look, we'll get this early if you can show you're going to die before you can enjoy it. This chronic illness and long-term care riders are much more beneficial.
Absolutely.
Thank you, Rob. Lisa, we got anything in the box there other than comments on your new hairdo?
The comments on my hairdo are filling up the chat box, but alas, no, we have no questions. But folks, if you're looking for contact information for any of our panelists, it is in the chat panel right now. But otherwise, any closing remarks, gentlemen?
And anything to say?
I would just add on to what Steve and I think Matt said earlier. If you need help positioning any of these concepts, ideas, reach out to all of us, and we're happy to help with clients.
Well, let's just again, CPS greetings from the Bluegrass State here. And remember our motto, which, Rob, I've got to give you credit again for, is that remember, even the rare bad day at CPS is better than a good day anywhere else. Thank you, Rob, so much. Lisa, take us out of here, Lisa.
All right. Thanks for joining us, folks. Have a good day.